Kelly? Okay, awesome. So, what do you want to learn today? Why did you came here? Okay, it's 12:04. We're going to start in 1 minute. Kelly saying additional spokes for business with a new idea. All right. I'll give you several new ideas. I see some more people joining. Welcome. Lori, welcome. I have 13 participants. Okay, let's get it started. So, today I want to talk about saving on taxes with real estate investments. Now, in 2022, we have a little less than 3 months before the end of the year that we can take advantage of regulations that are helping on tax write offs that can reduce your taxes right now, this year. All right, so let's get it started. The idea of today's seminar is to talk about those tax reductions and those special benefits from the CARE Act. They're available now until 2022. I'm going to talk about how to find the best deals so you can invest passively. And why I'm doing this is to have financial freedom, right? I don't want to depend on my business. I don't want to depend on working. I want to be able to build a portfolio of investments that I can live off and do whatever I want. So that's the objective. A little bit about myself. I'm the founder of Etman Multi Capital. I'm an engineer. I have an MBA. I worked almost 30 years with big companies: Intel, Lucent Technologies, Global Crossing, Yahoo, doing business development, going to new markets, launching new products. And at the end of the day, I said, you know what? Uh, Enough of working for other people. I want to work for me. So I opened my own business. It's called House Master Home Inspections. It's a franchise of property inspections. We do property inspections, mold, termite, 4-point, wind mitigations, drone, infrared, zero line, everything. And now my franchise is number 3 in US. I wrote a book about inspections. It's what every realtor should know about home inspections. And I'm well known here in South Florida in Broward. And I want to share a little bit of my experience on real estate investment, how I use my skill of property inspections to find the best deals, how you can take advantage of their experience as well, and what are the deals that can help you most with tax deductions. Before that, let me do a quick poll here. Um, Let me ask a quick question here. You're going to see a poll in your screen. And one of the challenges that I have, it's being able to save money for retirement, being able to save money for my kids' education. My kids are going to college, and it's not easy. So, do you have also kids that are going to college? Are you trying to save money for college? Let me know. So now I have 12 people answer. It's no, 7 people answered. It's kind of half and half, right? I'll give you another few seconds. See if you can uh, respond to the poll that is in your screen. I have 14 participants, 10 people answered, half and half. All right. So, yeah. So that's the poll, half and half have kids going to school. Yeah, that's always a challenge, right? Saving money for retirement, saving money for education, and end of the year is approaching, and I'm already starting to think on taxes. I have to file my taxes for 2022. I'm trying to forecast how much money I'm gonna make, how many taxes I'm gonna have to file to try to budget and leave some money aside for taxes. And that's something that we always think about it, right? How we're gonna save money and avoid taxes. So I see here the poll, and the results are everybody wants to save money in taxes. That's true. All right. So another one, I have just few more. I'm trying to learn a little bit about you. I have started investing in real estate. The last few years has been recent, and I love that so much that I want to share my experience with everybody. And I have been studying and learning new strategies. So I have this pool here where I'm asking the question: do you invest in real estate? So it's half and half now. Let's see. 9 people answered. We have 13, 14 participants. I'll give you a few seconds. And the results are it's about 60% invest already in real estate. All right. So we can share some ideas if you're not investing already. Hopefully, I'm going to give you some ideas of the benefits and some ideas on how to find the best investment for you. All right. And the last poll is: do you know anything about cost segregation or accelerated depreciation? Let's see. 8 people answered. We have 13 people. 8 people answered the poll. All right. And the results are half and half. Some people know about cost segregation, accelerated depreciation. Some other people don't know. So that's my goal here. I'm going to cover all those concepts. Awesome. Great participation, guys. You're awesome crowd. Amazing. Okay. So let's jump into directly the answer to the question. There's a lot of webinars that you watch, they leave the answer to the end. I'm going to give you the answer at the beginning so you know. And then I'm going to develop and give more information as we go through. But the key thing here is that the government during COVID, through the CARES Act, enabled 100% bonus depreciation for qualified investment property. So usually, if you have a building or a house, you can depreciate that value throughout the life of the asset. For commercial real estate, for example, 27.5 years. So every year you take 3% and you record as a loss on your tax return. So you can reduce your taxes with that benefit. But now, in 2022, it is possible to get a portion of that depreciation and accelerate and bring to just 1 year. So that gives you huge savings on your tax returns. And that is done through cost segregation. So what is cost segregation? We're going to split components of the building. Instead of saying, well, the life of the building is 20.5 years, now we're going to get those components. So we have kitchens, we have stoves and cabinets, phone lines, AC, water heaters, all those components. And then on those components, we're going to give them a different life expectancy. For example, for cabinets and kitchen appliances, it's 5 years, right? So we're going to break down those in smaller components. And the benefit of the bonus depreciation that we can get those components, and instead of depreciating in 5 years, you bring everything to year one. So right now, in 2022, you get all the price of the kitchen, the cabinets, the appliances, and you depreciate right now in 2022. So this benefit is going to phase out, and it will reduce in 23, 24, 25, 26, and in 5 years, it's gone. So that's the year to take advantage of those. So all investments that is done in real estate, in qualified real estate investments, before December, and we only have less than 3 months to do, we can take those huge tax savings and reduce your taxes. So you invest money, you make money, and you pay less taxes right now. Before the investment goes, you take these advantages right now. And an important concept on this uh, depreciation is that on real estate investments, we can take the advantage of leverage. So, what is leverage? So, let's say you're buying commercial real estate for $10 million, right? You don't need to come up with $10 million. You lend from the bank 80, 80%, 75%, 70%, whatever the ratio is. You lend most part of that investment from the bank, and you only come up with a down payment. It's similar when you buy a house, right? If you buy a house, you give 20% down, and the bank gives you the other 80%. So because of that, the depreciation that you take advantage on the real estate investment is not of how much money you're investing, but is in the total value of the asset. So let's say in this example of $10 million, the bank lent you 7.5 million, and you came up with 2.5 million equity. The depreciation is not over 2.5 million; it's over the 10 million. So that 3% that I told you over here, it gets multiplied by 2, 3, 4, 5, 6 times, depending on how much money you got leveraged from the bank. So in my example that I have here, the depreciation over $10 million would be $363,000. That is closer to 14%. So right there, you invest a little bit, but you take advantage of the depreciation of the entire building, and that goes on your tax returns. It's a tax write-off right there. But with the accelerated depreciation in qualified investments, because we separate those kitchens, appliances, those elements, and we brought those 5 years to 1 year, that depreciation impact might be higher than 14%. It might go to 20, 25, 30, 35, 40. I saw even investments giving even more. So 20 to 40% is a very interesting number. So let's say right now in 2023, if you invest $100,000 on those kind of investments, you might get on your K1 in your tax deduction a write-off of $20, $30, $40,000 of a tax write-off. So you take directly from your taxes. You can't find any other investments with this benefit. This is just unbelievable. It's a great benefit from the CARES Act that is available in 2023. Guys, I see we have 17 participants. Some people joined it recently. If you have any questions, type here on the chat. I can answer as I present. Don't be shy. Anderson, nice to see you. Thanks for coming, my friend. Very good. Judy, good friend here. Awesome. Let me see who else I know here. It's an awesome, good friend here. Nice friends. Awesome. It's good to see people that I know. It's nice to meet you. New people that are coming here, and we're getting to know. Anitson has a great question. How do we participate in that depreciation? Yeah, I want to take advantage, right? I want to pay less taxes. I want to invest my money and reduce my taxes right now, 2023. And I'm going to give you all the details in just a few slides. But we have several suggestions. One is multifamily syndications. They're available right now. We have few deals, and Nissan is going to talk a little bit more and share some ideas, and you can take advantage by investing on those properties. So let me give you some more information. But before I move on, let me give you a few disclaimers. I'm not a CPA. I'm not a financial advisor. You need to consult with your accountant and with your financial advisor. I'm not qualified to give you tax advice. It's just a general idea that I see from my investments, that I learn it from accountants, that I learn it from other people that are doing. So I see that happen, but I cannot give you that tax advice. Don't take my word. You need to do your diligence, and you need to talk to your accountant, because every case is different. So, but to answer an instant question, so let me give you a more detailed example. If you're a realtor or you're working, let's say you made 100,000 this year, right? If you're a realtor, let's say if you close 10 deals, 10 houses, you got 2% commission, that's going to be 100K. So if you made 100K and you're married and your wife or significant other or husband made another 30, 40, 50K, probably you're in the 25% tax bracket. Some people are more. Some people are making 27 and a half, 30, 35, 40%. Depends how the more you make, the more you're going to pay. But overall, the average tax, if you're making around 140K per year, it's in that 25% bracket. So if you make 100K, you're going to pay $25,000 in taxes right now, right this year, 2022. But on the other hand, if you get your retirement, your funds, that money that is saved in your bank on your other investments or in the stock market, you take that out, right? And you reallocate to real estate investments. Let's say you have 300K that is saved for your retirement, for your student education, whatever the goal is, and you invest in multifamily syndication. If those investments qualify for those accelerated depreciation, bonus depreciation, let's say you get like 35% tax credit of that $300,000, that will be a deduction on your. You're going to receive a K1 from the accountant, from the investment. It's $100,000 deduction on your tax. So you made a 100K on paper. You have the deduction of 105. Now your net minus 5. So you just save $25,000 in taxes. You pay zero. It's possible for you to pay zero if you invest in those qualified um, opportunities. So your money is earning and you're reducing taxes. Right there is a great return already, right? $25,000 of 300,000, it's 8%. Right there, you already make that money. So that's good. So what assets, what opportunities would qualify for those tax deduction? So one of the assets is large multifamily buildings. Those qualify. Um, and the idea here, the government has few goals, right? The government wants to generate employment. So the government creates incentives for companies to generate employment. And the government needs to provide housing, but the government cannot provide housing. So they create tax incentives for companies, for investors to create housing. And there are other incentives for food and energy, especially on solar. This year and the next 5 years to come is going to be very big. Food is also very big. But let's talk about the housing. And on the housing, to promote investments in the housing, they created all those benefits. So it's not all investments. If you buy like a single family property to invest, that doesn't qualify. But those large multifamily buildings that's classified as commercial, they would qualify um, for those incentives. So now I told you how you can save money on taxes. What is the timeline? How does that work? The second part here of the presentation is how to find the right investment, right? Because of course you want to maximize your returns and minimize your risks. So I'm going to give you some tips in just 5-10 minutes, and then I'm going to tell you right now how you can invest today and take advantage of those tax benefits right now. Guys, type questions here, comments on the chat. We have 17 people in this call. It's awesome. It's great crowd for the first one. I have many more that are coming. I started a YouTube channel that I've been posting tips for real estate investment every couple of weeks. So stay tuned. A lot of education and good information is going to come here. So 3 risks that we have. We have the economic risk, we have the investment risk, the building performance, and then we have the risk of the team that is running the investment. So I'm going to address those 3. I will give you ideas on how you can reduce those risks. So starting with the economic risk. So the economic risk is, if the market economy goes down, so there is not enough employment and the economy is not doing well, that can affect your real estate investment, right? So what we do here, we look for places where there's strong job growth, where is strong population growth. We studied the percentage of renters and buyers, cost of the housing, what are the market cycles to find the right location that has the best results. And sometimes the location is far away, right? I'm here in Fort Lauderdale, in Florida, but sometimes the best investment is not in Fort Lauderdale. Might be in South Carolina, might be in Kansas, might be in Texas. So we are looking nationwide to find those best markets. And when we go to the market, we look at other indicators that are also very important, right? What is the access to employment? Are the jobs being generated nearby? Do they have good schools, retail, is low crime? Usually the best assets are not in the center of the city, is outside of the city, suburban, right? And the suburban is usually more resilient to economic downturns. Student housing also, it's a great asset that has been proven to be recession proof and inflation proof. Multifamily, those workforce housing, multifamily has been proven one of the most resilient assets in the entire class. So we have seen a lot of immigration from outside and from inside the United States to the Sun Belt, to the warmer areas, like Texas, Florida is growing very much, Georgia, Carolinas. A lot of people are moving to those states because cost of living is lower, um, more jobs has been generated. The state has incentives for people to start business with lower taxes, and that has been attracting a lot of investments. Not talking about in addition to the climate. So we're always analyzing, what are the trends, what cities, which how they compare to each other to find the best opportunities, the best markets. Then we have the property risk. So I talk about the market. If you invest in a strong market, you're going to minimize the risk. A place that is growing and generating employment will have less risk to suffer if there is a recession or an economic downturn. So finding the right market is very important. So number two, the property, right? The property, there are different kinds of assets. We have A class, newer building. B class is a little older. C class, it's much older building. So there are different classes. So finding an asset that is a little below their market, like a B class asset in an A class market, it's a good idea because the market's gonna push that property and you have the opportunity to improve and bring the property to the level of the market. So finding the right class in the right market is another one. Finding the property that has strong financials and being conservative on the underwriting, on the study of the financial and profitability is very important. Taking into account the age is also important. And usually, overall, we try to look for properties where we have an upside potential. If we get an older property that has been outdated, it's a great opportunity to renovate, update, and push the rents up. So we are always trying to push the rents up to improve the valuation of the property, right? And here there is a big play of the economies of scale. So a lot of people invest in single family, buy, fix and flips and everything else, borrow strategy and so forth. But when you buy larger properties, over 80 doors, 100, 150, 200, 250, 300 doors, you get a lot of scale. You can have one person to be the property manager and look for tenants full time. We can have a person that provides support for maintenance full time. So if someone has a problem, they call, the guy is right there. So you have better customer service and you pay a lower cost. So you win twice. You improve the service and you reduce the cost, right? So let me give you an example. If you have a problem and you want to replace a toilet, right? How much do you have to pay for a plumber? $200, and you need to buy the toilet on Home Depot. But if you have a maintenance guy, you pay $20 an hour. So you see, it's different numbers. You don't buy from Home Depot, you buy from the company that sells for Home Depot. So you save a lot of money. There's a lot of scales, especially when you remodel and you improve those units. The cost is completely different when you do 100 than you do just one, right? It's the economies of scale. And also, when the property is bigger, there's more resilience on the economics. I'll give an example. If you have a multifamily with 8 tenants, 1, 2, 3, 4, 5, 8 tenants, and 4 people leave, you lost 50% of the revenue. Probably going to be losing money, right? And it's common to know sometimes 3 or 4 you just leave. But if you have 100-unit building and 4 people leave, you lose only 4% of the revenue. So they're more resilient. It's less risky. That's what we're trying to do. Find less risky assets. And I'll give you some alternatives that you can invest right now in just a few minutes and take advantage of those benefits. So what happens when there is a downturn? The economy changes, right? I don't know if we're going to have a recession next year or not. It's 50-50. Some people say yes, some people say no. But if we have a recession, the first one that feels is retail, like malls, maybe office, buildings, parking lots, storage, single family. Multifamily is usually the last one to feel the effect of the recession. Eventually, they might not even feel, because if it has been hard to buy a house, people will downgrade to those apartments. So the demand for apartments actually increase in a downturn. And Anderson, I agree with you. We might be in a recession right now. It's getting worse, right? I see, it's costing almost twice as much on the installment to pay a house. A lot of people are not, they're postponing their plan to buy a house. The real estate transactions this month, I see because I'm an inspector, dropped 40%. So yeah, something is happening. Good point, Anderson. I love that point. And one very interesting thing is, if there's a recession and all the homes starts to be sold at a lower dollar value, that will affect the valuation of your property, right? But in commercial, it's different. The value of a property in commercial is related to its profits. It's how much you're collecting in rent, how much you have in expense, the net result, NOI, divided by the number, a multiplier for the market that you are in, that's called cap rate, that is going to give you the valuation. Depends only on how much money you collect on rents and how much costs do you have. So it doesn't matter what is happening. If the house is being sold by less, the valuation is protected. And if more people are coming and there is more demand for apartments, the more it's going to be valued, because the rents will go up with supply and demand. Actually, today there is a lack of 5 million apartments in the United States. The construction is behind. That's why rents are going up in a faster pace than inflation on the last 5 years. It's amazing what is happening with apartments. And that should continue for another 5, according to most of the specialists in the market. So, and one way to create value for those assets, it's to improve it, right? So if there's deferred maintenance, remodel the kitchen, put a new bathroom. No one wants to have those faucets of 30 years ago. If you put a nice faucet, it doesn't cost much and creates a big impact. And the perception of value, we want to play with the perception of value. Value is what people are willing to pay, right? If you install, like, get one room, put a gym, that can bump your rents by 10, 15, 20%. Who knows? All depends on the market, Improve the office, install security, improve landscaping, refresh the furniture on the pool, install a barbecue, dog park, gym, covered parking, get an energy efficient AC, storage with Amazon, vending machines, wallet trash. It's so many things we can do. The list is just huge. That is going to drive the value. So we control the value of commercial real estate. We control the value by improving the aspects, exterior and interior aspects of the building, and creating the desire of people to pay more to live in that place, right? So if you go to a place like this, the one in the left, that's the reception, by the way, next to the office, you have a certain feeling. But if you improve to this one in the right, it's the same place. They just put some new furniture, a carpet. It's just looking beautiful. It's not a huge investment, but it's going to change the perception. So we control the increasing value this way. So a lot of people say, well, buy low, sell high. That's the success of sales. But here, it's not about buying low. It's about buying right and being able to sell better. Is how I can find opportunities that not are cheap or below the market, but opportunities that have the potential to improve and drive value and improve depreciation. So let me give you one example. Typical returns of those kind of investments, right? You get the rents, 6, 7, 8%. And then at the end, if the property improved, if the rents have come up, the value of the property is going to improve and come up at the same rates. So investors typically get a lump sum after 3 to 5 years when the property is sold of another 50%, 60, 70, 80% of their investment. Bottom line, it's very typical that people can double their investment. Kelly has a comment here. Solar panels would be 15-year improvement or be considered equipment 5-7 year segregation. It's a very important question. And Kelly, there is a new regulation now with this new package for incentives to install solar panel. So solar panels goes in a different dynamics. And I heard that applying solar panels in commercial, you can take from 50 to 75% of the value as a tax write-off on year one. So it's even more. It's another game. There is a specific benefit for the solar panels that are just approved. So if you want, I can send you more information. That is just amazing what can be done with solar panel. Anderson, awesome. Yeah, both you can get the accelerated depreciation 15 years and also those additional benefits. Perfect. Anderson, thank you so much. So what has changed? So those big commercial investments, they were reserved for wealthy families who has $3, $4, $5 million to buy a big building. Not everybody could do it. But now, with this new regulation, it's called Regulation D Rule 506C, that was approved less than 10 years ago. That's 2013. That's very new. That enabled private placement, enabled this structure of syndication that is very simple. It's just getting investments together, grouping them in order to buy those buildings and take advantage of all those benefits that are only at one time only available for very large investors. So syndication is a great model, right? So we group everybody owns the building, a small group of half a dozen people, 10 people, we're going to manage and run the operation, and you're going to take advantage of passive income, all that diversification. I can invest in several syndications, no management, all hands free. You had the tax benefits and you have all the control. You can choose which buildings you're going to invest on, different than in a fund that you don't control anything. So you control the investment and you get all the benefits and you get a lion's share of the results. So let me give one example right now that you can invest right now. So one example, we have this investment in Middleview is student housing, and we are projecting 2x multiplier, meaning that you invest 100K, you're going to take 200K in 5 years. So Nitzan, would you like to comment a little bit on how is this opportunity and how you see this investment?
Yeah, thanks, Caesar. Appreciate it. Hi, everybody. Nitzan Mosri, a friend, colleague of Caesar. And Cost segregation is something that I live by, and all of my investors enjoy as well. Can you guys hear me okay?
Yes, the audio is
Yeah.
very good.
Okay, great. Yeah, so I've been in multifamily for the last 13, 14 years. I've been in real estate for over 30 years. I have office buildings in New York. I have hotels in Memphis, glamping resorts. My core business is multifamily, and now we're branching out into student housing. And the reason why we're branching out into student housing is because one of the guys on the team comes from that world. He comes to us from a company called Landmark, which is one of the largest developer of student housing, and one of the largest owner operators of student housing. So he comes to us from there, and we have this project here that he's talking about is a Class A student housing that we got through his connections. So it's a completely off-market deal. It was built in 2018. And if you guys know much about cap rates, Class A cap rates in the market that we just left were trading at 3-4% caps. Even now, they might even go maybe up to a 5. But Class A properties usually tend to their cap rates tend to trend on the downside. We're buying a Class A 4-year-old property at 6.5 cap on actual leases that are being signed now. The purchase price is $12.85 million. We're assuming the loan of 5.7 million. So I think that's a 42% loan to value ratio. Yeah, you got that there, 40%. And like you said, Georgia College is part of that Hope Scholarship, right? And 94% of freshmen that come to Georgia College State University come from that Hope program. And the average median income for the families is about $114,000. So, it's a great property. It's walking distance to Georgia College. Every bedroom has its own bath, right? Its own ensuite. They have a common area. And it's just incredible. They've been 100% occupied since they got the certificate of occupancy for the last 4 years. And I think it was 2 days ago, they signed their 100th lease. There's 126 beds in this community. So they just signed their 100th lease for next year's tuition. This year, they're 100%. They're already 70% leased for next year. And the cool thing is that they're beating our pro forma projections, right? Our team put these numbers together and said, okay, this is what we're going to do on a conservative basis, and this is where we think we're going to go. And they're already exceeding our projections, which is incredible. So
Yeah,
there's
that's unbelievable. Usually, when we buy an asset, we wait 1-2 years to get those numbers. So those 5 years, year 1 or 2 is already happening in year 0. That's unbelievable. And
that's
if I
right.
had, I see my son is in Boston College and my daughter is in Philadelphia in Villanova. They have a bathroom on a hallway,
That's
right?
right.
And they
Mhm.
share their rooms. Imagine if could have like a suite, a private bedroom. This is amazing.
Mhm.
And
Yeah.
I pay on the college $1,000 per month
Yep.
for a
Yep.
shared bathroom. And
Yeah. They're
this
hitting
is
900.
700 is going now to 850 for a private
900.
bed. It's just a steal. It's just an amazing deal.
N- The rents now, the leases now are being signed at $900.
Wow. And the
Okay.
business case when you started it was 740 if I'm not
Correct.
mistaken.
Hmm.
So 740, the projection was to get closer to 1,000, and now you're signing leases at 940. So business case is implemented before closing. I never seen that before. That's why I'm investing in this property with Nissan. I'm part of his team in this deal, and I love this so much, and that's why I want to share with you because this is just unbelievable.
And what's nice is that, we're closing in, by before the end of the year, and everything that you talked about, the cost segregation and the accelerated depreciation, that's coming to us this year. So, if you guys made money this year and you don't know, you're like, oh, you're looking around, you're going, damn, I'm going to pay a lot of tax. You invest in an asset like this, you get that accelerated depreciation. That reduces your tax liability because, again, I'm not a CPA. I only play one on television. right? But talk to your CPA about cost segregation and accelerated depreciation and how that affects you and your tax liability. Because it's great.
Yes.
I got to tell you, I spoke with my CPA 2 weeks ago, and we went over my tax returns, and I was a happy camper because of all the depreciation
Me
that we did.
too. I had the same thing. My business is doing well, my property inspection business. I said, I want to reduce taxes. And I don't want to, try to find expenses here because then it's going to impact the valuation of my business. And that was the way. I found a solution for me. Now, with all those real estate investments that I'm doing, I'm going to get those key ones with those deductions. I'm going to generate those artificial um, costs that they don't exist. It's only on paper while investing at the same time. So this
Mhm.
is very unique. That's why most 70% of millionaires, they got millionaires by investing in real estate and reducing the taxes. That's their formula. And now we have this formula accessible to everybody.
Yeah. And Caesar, if I could just say one more thing about student housing itself. Uh, there's an article out there where a group, a fund now, uh, they're raising, or no, they're spending, they're building $500 million worth of student housing. They're building 4,000 units to house 4,000 students in University of Indiana, Wisconsin, where's the other one? Orlando and Georgia. So they're going in, and they say that there is an immense need for student housing. And the Georgia College State University, the city itself, Milledgeville, is not zoning any more properties for multifamily construction. So they're not building any more multifamilies. So there's a huge shortage of housing. And the Georgia College, what they did, they released a sanction of sophomore girls. They used to say that sophomore girls had to live on campus. Well, because they're growing so much, they released that sanction. And now you've got 500 sophomore girls walking around Milledgeville going, where am I going to live? And all we need is 126, and we're already 70% occupied.
Yeah, I never seen that before because usually in multifamily buildings with value add and the play that most of the syndicators are doing, we're trying to get rents um, done for the next month, right? We're always planning next month. And now, Nathan, you're planning for the next year. That's
Mhm.
another game. So 1 year in advance, you have 70% committed. This is just amazing. That's why I like that so much. Kat is saying here, my friend and his family do student housing. That's something that I have begun researching. Katie, yeah, do a research. If you want a later schedule call with me or Nathan or anybody from our team, we're here to help you. This is a good way to start because you really only learn about something when you start doing it, right? I'm this way. I read books, I watch webinars, I get education, I meet people, but I only really learn when I start doing it because I see those financials coming every quarter. I see those distributions. I ask questions about how they are doing, how, why, and I get all this intelligence from the operators that has been doing for a while, and then I learn. So if you want to learn, you start investing, and you're gonna learn. But that's my advice. That's what I have done. And after I started investing, my learning got multiplied by several times.
Mhm.
So just to finalize here, I don't want to extend too much. I know that the time is very valuable. Everybody's very busy and everybody has a lot of things to do. But if I could come back to the future, right, get a time machine and go to the future and come back and see myself today and give an advice, I would have done this before. I wouldn't have waited so much, right? So the best time to start is yesterday. If you haven't started yesterday, the best time is today. One very interesting about this, there is no commissions. There's no commissions. It's different from funds. You are the owner. You get the lion's share of the profits. And one thing that you can do also, you can invest your retirement funds. So all those big companies like Fidelity, Vanguard, they want you to believe that the only option you have is to invest in bonds and the stock market. Well, the stock market has been giving 8% average on the last 20 years. And real estate investments, multifamily syndications has been giving from 12 to 20. So it's 50 to twice as much. So 50% more to twice as much. So it's very different compounding over time that can make a difference. You might be able to retire sooner or with more money or help more people and impact family and friends and other people that are in your circle. So if you have questions, take a look on my videos on YouTube, ask me questions, call me, whatever you want to do, so I can show you how you can self-direct that money that is locked in your IRAs, 401ks, or retirement funds in self-directed funds that you can control and you can put on the syndications. So you're going to have more control, more income. So for this specific deal, I posted here in the chat. That's the link. Go to the portal. You can download all the documents. They placed the PPM, the memorandum, the offer. All the details are there. You can schedule calls with us. We're here to help you. If you register, please use the ID Caesar so I know that you came from here so I can track you. And let me know what questions do you have so far.